while in this case it's captured and there's not that sort of weakening of the effects. So the second comment is also when we look at information, there is a big difference, because this is the information in the paper, as you can see, there's no effect on real variables. On IP, where there's a strong effect, almost a shift in the level of CPI, which makes me think that potentially there is a different way in which information shocks and conventional monetary policy shocks are unpacked, and then we are looking at essentially a different combination of them. While in some previous paper of mine, if you look at the orange line, you see that information shocks have sort of strong effect, both in terms of output and prices. So that's the first point, basically. Perhaps there is a question about how we disentangle information and monetary policy shocks, and there's maybe a debate to be had in the literature on that. The second point is that this is an identification that's strongly based on the assumption that markets are able to disentangle in real time on impact at the moment of the announcement between the information component and monetary policy shocks. Now, this is something I've done to check. It's a response of S&P 500 on impact and for 20 days to what I identify as monetary policy shocks and as information shocks based on the internal forecast of the Fed. So these are the component of the surprises that correlates with the forecast of the Fed. As you can see, markets react pretty much in the same way for 20 days. And that would make me think that on impact markets are not really able to disentangle fully information from monetary policy shocks. The third comment is there's a sample issue, potentially, because in this paper we look at conventional monetary policy over the period of the zero lower bound, which is a fairly long period where there's very little happening in terms of conventional monetary policy. Now, there might be differences in transmission. There are many papers discussing that. One is the Sophocles paper, 2021, on econometrica, but there's potentially also an issue of lack of identification of that period, and then there might be a downward bias in the effects. Now, this is a table showing you the variance decomposition for conventional monetary policy, identified in the standard way. And the thing I want to point to you is that if you look at the second row, the period 1990-2012, where there's a large section of zero lower bound, you find very small effects of monetary policy, 8.1 of the variance, while any other period delivers much larger effects. So perhaps there's also a contribution there in terms of the sample. My one to the last comment is instead about QE. Now, as we were looking at in the discussion before, the identification delivers us QE shocks or sub shocks that have a very clear effect in terms of the movement of the yield curve, but not a significant effect on the markets. Now, if you think about the effects of QE, we would expect the markets to move. If there's a QT, we expect market value to drop. However, there's potentially a second type of shock that will move the end of the yield curve and move the market in opposite direction. That's risk premium. And in fact, if, for example, you look at the work of Cieslak and Schrimpf, they identify monetary policy in terms of QE on the long end of the yield curve and risk premium using a very similar sort of intuition, but essentially looking at differences in the co-movement of the stock yield covariance. So unconventional monetary policy and risk premium shocks are the bottom part of that table and identified by looking at the long end of the yield curve and different sort of correlation with the stock market. Now, in this case, we don't have a clear correlation, and there's the potential for blending these two shocks. However, the remark here is that if we have risk premium shocks, and perhaps in the form of flight to safety, they would sort of weaken results, while we have fairly strong results here. Now, the point, however, is that as in the case I was showing you before for the information shocks, where there's a strong effect on prices but no effect on IP, whenever we rotate the shocks in a dimension that blends to shocks, the outcome will depend on how much of the variance of a single variable these shocks explain and the composition of shocks in the sample of consideration. So we can have very different effects on the given variable. Last comment I want to make is whether large events are uncorrelated, because this identification is based on the idea that large tail events are essentially uncorrelated. And when there's a large tail event in information, there's none in perhaps QE. Now, this is a table from something we are doing here in South Africa with Nicola, Caterina, and Charles. And it's a table of the large events in the sample across 4 types of large events that we call short-term, medium-term, term premium, and country risk. And as you can probably see, I'm not sure, there are bold numbers here. And these are the largest events. And as you can see, when there's one, usually there's another, or under 2. And that's the idea that when it rains, it pours. In the sense that when there are bad things, then the central banks moves a lot and perhaps surprises the market, and term premium moves and risk premium move. And maybe there's also information. And that sort of might weaken the identification. And that's partially true also for the US. This is the 2 series of fuel guidance and information on the path, separated using the forecast of the Fed for the US. And as you can see, in recession, there are large monetary policy shocks and large information events. So perhaps, again, there's something to be discussed there. Let me conclude. A great paper, very timely, very ambitious, pushes the debate on important questions that are not yet settled, and we need that debate to be lively. But yeah, perhaps there's still an open debate that we need to have. What, as economists, as a profession, we need to do is to try and find robust patterns, because that is meaningful. And perhaps we're not there yet as a kind of empirical macroeconomist. Thank you.
You want to take some questions first?
Okay, thank you, Giovanni. Great comments. Thank you also for sharing them in advance. So you had 5 comments. The first one is the one that why does conventional monetary policy have so little of an impact? I think this is primarily a labeling issue, because remember, the labeling of these structure shocks in this identification approach happens ex post. So I wonder in the meantime whether it was a tactical mistake that Marek did to label this first shock as a conventional rate policy shock. For example, he could have labeled it as a short-term forward guidance shock and the second shock as a medium-term forward guidance shock, and then I think fewer people would have taken offense by small effects of a short-term forward guidance shock. So that's one part of my response. The other response is that it's a very legitimate question to ask, okay, why does this literature that uses surprises in the federal funds forward at very short maturities and so on and so forth find large effects? If you look at, and this is what Marek does in his paper, if you look at correlations between his conventional rate policy shock, the forward guidance shock, and these federal funds surprises, then actually there's a strong correlation between the forward guidance shock and the short-term surprises. So in other words, a lot of the variation that is in the short-term surprises gets actually absorbed in the forward guidance shock. And so you can think of, okay, what's left ends up in the conventional rate policy shock, and that just turns out not to be consequential for the macro economy. Last response on this one is actually interesting to note that this issue of small effects of this conventional rate policy shock is really not something that's specific to Marek's. Okay. Can you help me put this up? It's actually not specific to Marek's identification, because if you use Swanson's identification, which is also trying to identify forward guidance, LSAP, and conventional rate policy shocks, you get essentially exactly the same. So there's something in the data that is manifesting in various identifications that could be labeled as a conventional rate policy shock, which has that pattern, right? So for example, what we What you see here with the red crossed line is what you get when you use Swanson's conventional forward guidance and LSAP shocks. And for the conventional shock, you get literally the exact same impulse responses. So it's not specific to Marek's identification. There's something in the data. Second comment, why don't we get expansionary effects for what's labeled as a central bank information effect? Again, let me say, okay, we're not invested in this being a central bank information effect, or maybe some other residual component. And if it's some other residual component, who knows whether it should have, according to theory, expansionary effects. But in any case, let me just mention that in terms of unemployment, it's expansionary. I didn't show it in the slides. I don't know why it turns out not to be expansionary for GDP and for IP. It could be sample relative to what you did, could be specification, controls, many different reasons. Variation in transmission, very fair point. We don't look at it. Maybe we should, but it's a very fair point. Then the LSAP shock, why doesn't it contract equity prices? Is this because of risk premium shocks? I think this is also a bit unfortunate because we decided to use Marek's baseline time series of LSAP shocks, which is estimated from 1991 to 2019. So arguably there was no LSAPs before the global financial crisis. So you could argue, well, estimate it only after the global financial crisis. If you do it, you get contractionary effects on equity prices. Again, if you use Swanson shocks, they're very much correlated with Marek's LSAP shocks. So it seems not to be an issue related to the identification, but more to something that's in the data. And lastly, these large events are correlated oftentimes, or let's say movements in various asset prices are correlated in terms of size for many events. So again, I have to resort back to Marek's paper because it does a lot of robustness checks there. And he departs especially from this assumption of mutual independence of these structural shocks and allows for a lot of common stochastic volatility. And even then you get essentially the same time series. So I think that is taken care of by this. So maybe I already, yeah, okay.
Questions?
Yeah, thanks, very interesting. So, I mean, I had also the question on why the conventional shocks don't matter, but especially because probably before GFC, as you said, most of the shocks were more on the conventional side, and whether, you know, then monetary policy just didn't have any effects, right? That seems rather unreasonable. But then I guess another way to put it is to say maybe it's like the long rate that matters a lot rather than the short rate, and before we had a lot of forward guidance, the way the long rate was affected was through conventional monetary policy, because policymakers didn't tell us what's going to happen in the future. Instead, like setting the short rate was the way to affect the long rate, and now it's different. So maybe before the GFC, the effect was going still through the long rate, but through setting rates in the short rate, right? So I don't know if that's another way of kind of putting the results. And you could, I guess, test that, right? By just restricting the sample and see, you know, whether you find a stronger effect on, because you see that the 10-year rate also is affected by conventional shocks, right? Maybe that's stronger before the GFC.
Should I respond right away? Yeah. Okay. So, I mean, yes, that's something we could explore, but let me say again, I'm not even sure that there is a puzzle in the first place. I'm really not sure whether this is just an unfortunate outcome of this label, or the choice of labeling this as conventional and forward guidance. Because again, the standard surprises or standard external instruments that are being used in the profession, if you think about it through the lens of multidimensional identification, they are driven by various unobserved components, and it just so happens that one of those components is loading a little bit more on medium-term treasury yields, and another component is loading a little bit more on shorter treasury yields. And it turns out that it's the first one that matters for the macroeconomy. And that's not specific to this application. That's also specific, or that also applies to the existing applications. If you did this distinction.
Let me disagree with that answer.
Sorry?
Let me disagree with that answer. That it's okay to have different kinds of forward guidance surprises in the data, but there has to be a monetary policy action surprise, right? In the data, there is such a thing that, you know, we expected the central bank to do, came out of that. And that has to be somewhere, and it's not forward guidance. So you can't resolve this issue by relabeling the surprise. Because if you just said, in the data, I only see a short-term forward guidance surprise and a long-term forward guidance surprise, then the question will be, well, where is the monetary policy action surprise? It has to be there. And it's very difficult to imagine forward guidance being so influential if the policy action itself isn't, because the forward guidance is forward guidance about the policy action. So how can you have signals about the future actions being so effective without the action itself having no effect? It's also not the case that before the global financial crisis, most of the action was coming from these, monetary policy action surprises. I think a better answer here is that there is very little identifying variance in what we would like to think about as the monetary policy action surprise. Starting in 2003 or so, the Fed became so good in signaling what they're going to do that the variance of that monetary policy action surprise gets very small. So it becomes very difficult to identify in the data what it does because you see so little of that. And that's not a zero lower bound issue. It's an issue about the Fed becoming so effective in telegraphing what they're going to do in advance.
So I would agree and disagree at the same time in the sense that what this means through the lens of this multidimensional identification is that there is an additional primitive source of variation of these asset price surprises, but the signal in these asset price surprises is just so small that it doesn't pop up as one of the shocks that Marek identifies. And so again, and that's the disagree part, this first shock, you could still label it as short-term forward guidance or another way, and the second part as a medium-term forward guidance. And you will find that this short-term forward guidance turns out not to measure to mean much, and only the medium-term forward guidance shock means much. But it still wouldn't rule out that the policy action component is inconsequential because it's not reflected here. So in that sense, I agree with you. Yeah.
Yeah, so I thought this was a very interesting paper. I kind of want to take the discussion a bit towards your paper rather than your co-author's paper, which I think a lot of the questions were about this. So if we want to think about the spillovers here, one of the things I like is you seem to find some evidence that ELSAP had a much larger impact in terms of the impact on the foreign markets than conventional, subject to some of the caveats that have been discussed. I'm not exactly sure I understand how you end up concluding that it's mostly risk aversion or risk appetite. You do get more transmission to the term premium, for instance, than conventional, because you don't have much on the conventional side. But then there is a question I wanted to ask, which is, I'm assuming that you're not controlling for anything that happens in terms of the monetary policy reaction in the rest of the world to these US shocks. And that could also be different depending on the type of shock, and that could also impact some of the results you have there. So I'm kind of curious when I look at this, should I think of this as just reduced form that is also absorbing whatever the foreign central bank is doing, and is that the right way?
So yeah, so the reason, the way we conclude that it's mainly variation in risk aversion that's giving rise to the spillovers from LSAPs is, admittedly reduced form. It's circumstantial based on the patterns in these impulse responses, so it's not really rigorously structural. Giovanni tries to go some way in his paper on this one by shutting down particular channels. We don't do this here. So in that sense, it remains circumstantial. At the same time, I think to the extent, and I hope I understood the second part of your comment correctly, but as long as these shocks are really shocks, exogenous variation, then it doesn't really matter what we control for in these local projections in order to get consistent estimates of the responses of variables in emerging market economies. Right? We could even control for anything, for nothing. As long as these are really shocks, exogenous shocks, then we should get consistent estimates, at least asymptotically.
I don't understand this one. If the other country assumed as a fixed exchange rate, that will respond automatically to what the US is doing to maintain the exchange, the transmission to output and inflation to be varied, then you can have a fully.
So this is a common heterogeneity across countries. Yes, fully on board. We don't distinguish here across countries in terms of the country characteristics. Giovanni again does this in his paper. We took the decision not to go along that route and to explore what's the role of the exchange rate regime, what's the role of capital controls, what's the role of other vulnerabilities. We just speak here about an emerging market aggregate. Yeah, but fair point. Thank you very much.